thank you for coming with us today, and let's take a look at the markets and talk through our current situation. I think the major market news this week will be on Thursday, or at least the hard numbers coming out. We're on Thursday. We'll have the prospective plannings report and also grain stocks report. I have some poll estimates of acreage numbers. This came from Reuters and came out on Friday. You can see the USDA's, that average trade estimate. I think if you can see with my pointer here, Rich, can they see that pointer? Does that help? Anyway,
yes.
Okay, good. So you see the average trade estimate of 91.8, basically just under 92 million. Last year we had 94.6. So, if that happens, you're looking at about, let's see, on the fly here, about 94.6 minus 91.8, 91.8. So 2-3 million less, I think 2.526. The USDA Outlook Forum actually projected 91. So the average trade estimate is a little bit higher than the USDA Outlook Forum, and so the acres lost then, or the acres acreage reduction from last year, if this ends up and occurs as is projected here, from 94.6 down to 91.8, is offset largely by a trade with soybeans. So here you have the the average trade estimate of 86.5 million, 86.53 million acres compared to last year at 83.6. The USDA Outlook Forum is 87.5. So the trade generally thinking less soybeans than the Outlook Forum numbers. I guess the changing in these numbers that we experienced last year really I guess really had an impression on my thinking, in that I remember that when we came into the June 30th acreage numbers, the acreage figures, again, we have the prospective plantings at the end of March, then we come in again at the end of June with pretty well finished up, with a lot closer estimate, I guess, on the soybean side, on the crop side, given spring crops planting. At that time, the USDA came in and had major changes, and they ended up and raised USDA U.S. corn acres by about 2 million, and dropped soybean acres by about 4. So as we were sitting here at this point in time last year, we were anticipating about 87.6 million acres, something like that, 87.5, 87.6 for soybeans. And then for corn, if we ended up at 94, we were at about 92. So that's, to me, it's just a lot to ponder in terms of where this is going to go, and I think does put us in a situation where we have to take these numbers for what they are. They're pre-planting estimates. Farmers haven't voted with their own planters yet, and so we'll see where things are going. Generally, it's thought that lower corn prices, higher soybean prices, you can see in the USDA numbers, will favor soybeans, and the forward contract prices that we'll look at here in a bit, they're right there also. So we'll see where all this goes. I guess as you move on here to look at wheat, again, last year's planted acreage for all wheat in the U.S. was 49.6 million acres. The Outlook Forum projection, that's the number we ended up with, 49.6. The USDA Outlook Forum projected 47, and that's about where the average trade estimates are. You can note the range and on high and low of that. Winter wheat, such a conundrum. And again, a hard red winter that we grow largely in Kansas. We do have some soft red in the east, southeast in particular. But anyway, for winter wheat, you're looking at about ended up last year about 36.7 million acres. Outlook for them projected about 34.4, and we're at that or a little bit higher for what the trade is thinking. Spring wheat, again, last year 11.2. We didn't really talk about a specific number at the Outlook Forum, but 11.2, projecting that to be a little bit lower this year. And then you can see the Durham numbers just down just a little bit. So I guess when you look at the corn acreage numbers, so we have been to that high number last year, that 94.6. We saw some real changes at the end of last year on acreage figures, and that contributed to the U.S. corn yield ending up at a record high 177.3. It was until the last, I think, the January report. We were at about a 175, and then suddenly, gosh, we dropped harvested acres substantially, ended up 177.3. So and it really had no impact, or just small impact on the amount of actual bushels produced. So lots to think on there, and you can see on this that although the planted acres for coming out of the Outlook conference, 91, still just a marginal drop in the actual harvested acres. So lots of moving parts here. We'll take the information in hand, go forward, and then see where we're at. But generally, you can see there on the corn that as we just showed, that there's anticipation of a decrease in planted acres. And then for soybeans, there's what we ended up with in 2023. Again, we were sitting at about 87.6 a year 2023 going into June, and then so we come back again this year, and we're projecting 87.5, 87.6 again. So I obviously here farmers are going to vote with their planters, as we've already said, and they'll determine what they want to plant. We have a comparative advantage in corn production. We also do very, very well in grains, in soybean production. So where is the demand pull going to come from more? The talk in the industry, a general consensus is that, gosh, we're moving towards renewable diesel, more soy and oilseed based biofuels. So I guess stay tuned to see if that sentiment pulls soybean acres up as much as is thought to happen here on at least the first number out on Thursday. Sorghum, we in Kansas pay a lot of attention to sorghum. The USDA Outlook Forum number was about 7 million acres, down from about 7.2 in 23. That's for planted. You can see that we have been there before, about 7.3, 2021. Sorghum in our backyard, it's another conundrum in that the demand for sorghum, sorghum exports out of China in particular, very, very good. And sorghum cash prices higher than for corn, and we'll see that here in a little bit. But the new crop bids are at or for sorghum across the state, generally at or below corn for fall harvest. So whatever's happening in the cash market right now for sorghum, it seems that we are unbelievers with regard to thinking that's going to endure off into harvest. So we shall see how all that works. U.S. wheat, again, you can see that the wheat numbers, the hidden issues with wheat are that the difference, in my thinking, the difference between what we actually harvest and what we plant. Tremendous acreage in 2023, but look at the drop off. That is no small decline or difference between, well, basically it's 75, almost 25%, 24.8% unharvested. Now we're coming in projecting that, well, we think we'll have moisture, and we hope we do, and that we're going to move up in terms of harvested to planted. So we'll see. We're out here in an austere environment in the plains, and wheat crops all over have suffer these same maladies of weather challenges, and we'll see. I did want to show wheat planted acres by class. Hard red winter in the blue. We have been in the, again, Kansas, Oklahoma, Texas, and other hard red crops, hard red acres have generally been trending down for the, in essence, down to a low in about 2020, have come back up a little bit, etc. And so actually, if you have the long-term view, you're probably bemoaning the trend downward in hard red acres across the U.S., but that does seem to be stabilizing a little bit. And then you can see what's happening for hard red spring. It's declining some. Soft red winter, actually, soft red winter exports this year are gangbusters. That's standout class. It's cheaper. China's been buying it. And you can tell when China's buying something that when they buy a lot of it, they and they see the price change, they'll get out of those contracts and then buy it back later. So that's what's kind of happening. And you can see, of course, white wheat standing pretty strong, a little bit lower this year, and then durum. Let's take a look at weather. I think those of you that have old crop grain in hand are wondering about new crop bids. I think there's some, when we came out of February, switched our attention from the March contract to the May across all these commodities, we took on a new crop year 2024 mindset. Sure looks like to me. And of course, we said Thursday we'll have more data that'll give us more to work with. So we're starting to build the case and bring the attention to what we actually have, and that thing's going to be driven by weather. Let's take a look. According to the latest drought monitor, March 19th, it's pretty dry in places that's been dry the last several years. Iowa, again, another major dry area. Eastern Nebraska, good parts of Kansas, especially to the north. Southwest this year doesn't look so bad, although that Oklahoma Panhandle, we were kind of curdling around the border, and South Central, kind of dry. So, but not a lot according to this map, other than in Illinois, in the east and the south. When you take a look at this map, this is a drought monitor with how they collect that. This is a projected soil moisture in soil moisture profile in for the next, through the end of this month, a little bit longer, and it shows a lot drier situation in those three I-states. So we're sitting here right now. We're heading into planting season, and when I look at this up front, hey, we shouldn't have any major problems. We don't have any cases of too wet soils right now. It's we were able to get in the fields, go forth. So it would seem, if that doesn't change, that we won't have worries about. We're probably not looking to have major worries about getting crop planted. Our worries will be, once the crop is planted, how does it emerge in dry soils? Will we have moisture coming later on? So it looks like a kind of a soft market impact up front here, but then questions as to where this thing might go, as where the situation might go as we move off into past planning, late May into June, July, August, and then lots of potential with this much dryness for weather markets. Just another set of information to look at. This is short-term kind of conglomeration, I guess, of different weather maps, etc. The short-term view, again, Iowa, southern Minnesota, Wisconsin, show a little part of South Dakota, showing challenging situations, the boot of Missouri there. But the longer term composite, when you don't look at the short run, you look at the long term, which give us a view of what's a subsoil, what do we have going forward. Well, it doesn't look very good. It looks pretty rough, actually, especially in Iowa and parts of eastern Nebraska, parts of Kansas in that. Although this go around, as we sit right now, other than the southeast corner of the state, we're just kind of dry. And some other places, again, you're kind of surrounding Illinois, Indiana, major drought, dry areas. So stay tuned. I know that we've got a market narrative issue going on right now, to where we must all be Missourians with regard to actually waiting to see how crops work out. Even though it's dry right now, hey, it normally works itself out. We're not going to be fooled. It just seems that the markets after last year getting all excited that we had a shortfall, then ending up with great yields at the end. They just don't seem that excited to be very responsive to any fears of what's out in the future, which means to me they'll be, if that doesn't change, they're going to be more backloaded. They'll have to be proven to actually have short yields. I don't know. In my thinking, the longer they wait, the longer the market waits and says, well, good things will happen around the corner. Rain is coming. I'm not going to panic. Then when they get boxed in at the end, then you're just set up for a lot of volatility. A lot of volatility. The psychology of it, if nothing else, is out in there. So I'm not standing here saying that, gosh, it's going to be a wild and crazy year, although it sure could. But it just seems like we're decidedly not going to worry about future risks until they actually show up, which to me backloads the reactivity of the markets. So all this we've talked about in the U.S., this is how on the world map how it looks. And we have our issues we're looking at, but we've been watching these dry conditions down in Brazil and the wet conditions in Argentina. Again, parts of Brazil here, Argentina, down in these areas, southern Brazil, and got there's I guess just a question that will have to be answered when the combines actually pull those crops out of the field again. We've been I think for about 2 months now, there have been reports of on the local side from CONAB, ABOF, other groups like that, gosh, there's some problems here, there's problems there, but we're just not seeing yet, pardon me, any major issues that, or at least the numbers not coming out of the fields quite yet that would indicate real short crop. In fact, that here of late, the latest news out of that area is that they've had too much rain down in the Argentine areas that we thought were doing great because of moisture. Well, they've continued to rain, and rain makes grain until it doesn't, and it seems that they might be those numbers. Conditions might be deteriorating down in Argentina. So I think April 11th, the next WASDE report, and that the way the markets are tending to function or respond to news, they'll wait to see what the USDA says. And those are good folks. Talk with we know them well from KSU, and again, they have to be they're in the mode of being cautious and not giving undue uncertainty into the market. So they're watching this as it goes forward, and I guess the answer, in the way I view that, is if we end up short down in those areas, either too dry, too wet, it'll tell. But again, it seemingly is looking at like more of a backloaded psychological thing that pushes us later on for selling cash or buying new crop. Up in here, you're looking at the area of the world, according to this moisture map, that's not showing a lot of dry conditions. Now, the next one I'll show you a different picture, but again, you're up here in the Black Sea region, Russia having several years good wheat crops in a row. Ukraine, but they're resilient farmers doing very well, growing enough crops that they're as they seek to move it, they running into political resistance, going over land. So you've got all that happening. But if there's one thing that would turn the wheat market around, in my view, it's that um, it would be some type of a crop shortfall in this area that right now is just pumping out a lot of low cost wheat out into the world. And by the way, that low cost wheat competes for usage with U.S. hard red winter wheat. Some of it come out of that region, got down into shipping lanes, came all the way across the ocean, has at least come into up the a little ways, if not up to, I read of like St. Louis, etc. There have been some loads that have come that far up, and when you do see the amount of U.S. wheat imports this year, again 2 years ago, 96 million bushels of wheat brought into the U.S. for the marketing year. Then that's 21, 22, 23, 122 million bushels. This year projected at 145. So there's some substance to this issue of cheaper wheat imports coming into the U.S. and having an impact on our U.S. wheat markets. Again, you look at China, you see and India, you see a little bit of some dry conditions up in this part of India. When we were most concerned in the last several years, we saw that it was these dry areas up in here that we were more concerned about. It doesn't look like here you see a lot of problems in the North China Plain, etc. And see the again, Australia really affected by El Ninos, and you do see some dryness coming on now in the these New South Wales, some of these areas in the east, and some dryness along the coast there. So you see this map. So see, this is one way to look at this. I'm going to show you a more extreme satellite map. So this is out of NASA, and they call it the NASA GRACE project, and so you can see here. Here's how this more reactive moisture map shows our conditions. Things are looking, according to this map, things are looking rougher. There were some problems before in the U.S., but all that much more in this view. Rougher looking for sure in South America. Wetter. When it's dry, it's dry. When it's wet, it's wet. This one shows the extremes. What catches my attention is in this Black Sea region up in here. You do see more indication of drought around that that part of the world, and to me that's worth watching. Again, you see South Africa, pretty strong corn exporter, and it's got some dryness. Over these areas that we just sort of just kind of threw off before, and that this is showing in China, hey, there's some dryness and there's some extreme wetness. So a lot to think on there. So I guess just like in working with the medical field, it's nice to have a couple opinions. So here you got the more conservative one we showed before, and then this one that shows this out. So this is all you have to do is to go on the web, type NASA-GRACE, and this actually is tied in with the UNL, University of Nebraska Drought Center. They put this out. So good stuff, nice alternative perspective. And then you've got this. We've come out of La Nina before, for 3 years of La Nina, went into El Nino, and for this year, and and it was a weaker El Nino than had been thought. And now we're seeing a move thought by our climatologists to take us back to La Nina. I remember Elvin Taylor. We came and spoke at Kansas State University. You know, actually, I went to Iowa State University, and he was an advisor of mine on it was a new crop corn forecasting project that we had. So for the weather side, we involved Elvin, and so he said, and when he talked about what to be worried about for weather conditions, it was La Nina in the Corn Belt. So we have some risk of this coming on. You can see the synopsis right here. A transition from El Nino to ENSO neutral is likely by April, June. So we're just about there. 83% chance. Okay, fine. With the odds of La Nina developing by June, August 2024, 62% chance. 62% chance sounds pretty great, but you have to remember a 50% chance is a coin flip. So there you go. But the point is that we've got a non-traditional situation that's developing, and so keep that in mind. Again, I don't think the grain markets are not hardly looking at this at all, apparently, other than to know, hey, there's something out there that might happen. It's not here. We'll deal with it when it comes, and that's probably fine. That makes sense rationally to do that. But just know out there that if we're making grain pricing decisions, that we've got this big question mark out here in the summer months, again, June, August, right in prime time for crop development, about a La Nina coming back. And there have been years when that has hit that we've had some pretty, if it turns right, and that other factors also involved, it can be, we've had some pretty serious droughts coming in that case. Of course, we hope that does not happen, but just keep in mind that is out there. Okay, in the time we've got, I'm after kind of laying that foundation, I'm going to try to move pretty quickly through things. The slide set that was sent you before, all up to date on everything except about the last 10 slides for wheat. My snow scooping this morning to get here was before I got here, delayed my finalizing this set. But so let's hit on the things that I hope are of use to you in the markets. Feed grains, downtrend. Here you can see the May corn contract. Got this from clip and paste from DTN. Want to give them credit. DTN Grains. I have a subscription to them, and you can see we're down, closed yesterday at 439 and a quarter. Down in here was basically, we got low of about 410 around the time when the March contract was entering into delivery. So here we go. When we came out at the end of February, and came into March, suddenly we're starting to look now to new crop things, and rolled over a contract, and have basically gone from about 410 to 439 and a quarter since that time, and a fair amount of that in the first 2 weeks, and pretty much sideways since. And you look at the structure of futures. You're made a little bit of hyperbole before about how the market's not paying attention to La Nina risk. Well, it is to some degree looking at, again, well, here you see the March contract. This is closed out now, of course. That closed out in mid-March. Closed out at 423. May, as of Friday, 439. Excuse me. And this minus 11 cents a month, minus 22, is really showing where March went from December. So when that December contract closed, we're down about 22, 23 cents total from that. So storing grain, starting with that, was already a bit of a we have a hurdle overcome to make money on it. But you can see the carry. About 8 cents per bushel per month, total is 16, going up to May to July to 452, about looks like about 13 cents, and we are seeing out here geese, corn 475, and expressing some of the uncertainty, some of the questions, or reflecting that on where the crops will go, and to some degree probably not wanting to give any more away in terms of signals to producers as they compare corn and soybean new crop prices. They want to make sure that they're represented in terms of acres. And here you have actual cash markets. Now we have a broader audience, but we are looking closely here at this focus is basically on Kansas major market areas, and we kind of pick these communities to represent different sections of the state. Type in a zip code for Colby, Salina, Topeka, and see what you got within about 15-20 miles. So for corn, again, strongest bid, of course, 459 in Garden City, 20 cent over basis. Hutchinson's been pretty strong in relative terms for a good while. New crop bids, best new crop bid tangibly by 25 cents would be the 485 in Garden City, but you got a lot of these prices here. These prices end up, and they cover pretty well with any type of average or better yields. They cover direct costs very well. The issue is, do they cover full economic costs? By the time you add in the machinery line, if you're paying cash rent or trying to buy land and pay for it, they are at or below that, unless we get just astounding yields to spread the fixed costs out. So to get full economic cost coverage out of these prices, man, we got to have good yields. And grain sorghum, you can see the areas of the state where we've got a little stronger sorghum prices. Hutchinson 469, Topeka 454, and not too bad out in Colby and Salina. So pretty good cash bids. However, when you start comparing the new crop bids for corn to the new crop bids for sorghum, it seems that whereas the cash markets for sorghum are showing more strength because of this export situation, that we're not reflecting that. We must not trust the follow through for that situation to continue to exist once we get through this market year. So it is as it is. I wanted to show you this chart. This is a net position of traders. We've talked about some of these in the past. So we have in the red managed money specs, and in the blue commercial hedgers, swap traders, and then the charts up above. And the thing that we're in, the scale is in terms of millions of bushels. So this is like 2 billion bushels of long positions, about 2 billion bushels over here of short positions. And corn, definitely everything, all positions all thrown together. Excuse me, on the managed money, touchdown down to about 1.7, 1.8 billion bushels negative. And you look over here, that's better than that. That's around in there. So the current negativity we've got is equal to as much negativity in those positions as we've had since 2006. So it shows a market thinking pretty pessimistically. And when you isolate out those managed money traders, the specs who they're betting direction. They're not hedgers typically. You bring that in, and this isn't this. If it's not at a record, it's within shouting distance. It's just right there. And Note that when we've got down there in the past, these things don't tend to, in a lot of these time frames, we get really bearish and then we come out of it. So right now, there's frustration in farm country over lower than expected corn prices, and it's basically reflected in the positions of the traders. And right now they're pretty bearish. Even the long positions are kind of muffled. There have been a few less than that, but they're just kind of hanging around. The real consensus is on the bearishness. So I think it's fair to ask, well, where do we go from here? And here's the typical corn season average price index. You've got we come out of March into April, a little higher into May, a little higher into June, on average a little higher. You can see this 85% and 100%, 100% capture in all the percent moves relative to the season average corn price. And the big volatility May, June, and we're coming into April, so just a lot of dice being rolled on what this thing does. It gives us, if it comes about, it gives us old crop selling opportunities, gives us new crop pricing opportunities. So take this, so note this green line, and bringing this over and looking at what futures are reflecting right now. So futures at this point, they've come out of, so here's the season average price index running up until June, same I guess spread, and here you have futures came down February into March, expressed a low, and are moving a little bit higher, but they seem to be running lower than seasonality, than their typical seasonality. One thing that they're doing, they're holding up at the end a little bit better than when we tend to drop off. So anybody working for universities be really cautious about giving guidance on marketing. But I would say it looks like the futures are underrepresenting the production seasonality right now. They're showing some higher, but the percentage changes we typically see, they're either underrepresenting it, or we've got so low before that we haven't caught up to what typically would be going on. And one to add in here, in this chart, the season average price 476, looking at this futures approach, and essentially equal to USDA's 475. But the new crop numbers, by the time we get to fall harvest, and then look what the extended futures are showing, they're about 509. So they don't know where they're going yet. All they're doing it, and it's they're coming into fall harvest of 2024 and just showing kind of an uptrend. So just be thoughtful, I guess, as to what's going on out there, and just know that the futures for corn are decidedly more optimistic than they are, at least as my view, than soybeans are. I think the soybeans look at South America and are saying, man, there's a lot going on down there. I'm going to move pretty quickly through this. USDA came out of their USDA Outlook meeting, projected 181 bushels per acre for 2024. So the production numbers were strong, bearish. We've never been higher than 177.3 that we had last year. So in my own thinking, I'm more inclined to think, hey, let's actually meet that one first before we go projecting that one. But just so much depends on what you do with these old yields. Do you shoot a trend line off of old yields way back over here and shoot to the long side? If you do that, that's how you get that. But if you say, US wise, we haven't gotten much above this in the last several years, there's a real debate going on for that. Let's move on. I move on quickly in the interest of time. I would note in Kansas, the ethanol average corn price, sorry for the blurriness there when I clipped that. So out of USDA Ag Marketing Service report, the Kansas average ethanol price range of 461 to 486, average 473. The next highest area, well, it's eastern Iowa at 448, Nebraska 443 basically. So if you're a corn grower and a corn seller, you're thinking, hey, this is great. If you're a corn buyer to fill those ethanol plants, you're thinking, yeah, I'm paying more. But just to note, here in Western Corn Belt in Kansas, we've got the strongest ethanol prices by this measure in the country. Ethanol corn prices. Exports for corn, so, not the worst, not the best, kind of in middle range where we've been about at the 7th, 28th, 29th week through the marketing year. Grain sorghum, generally running pretty good. We've only had just a little bit better than average. We've had the glory years of Chinese exports, 14, 15, 15, 16 or higher than this, but given how challenging corn, especially wheat is, I guess bravo for grain sorghum, holding it pretty well. So let me move on to some things here. So that USDA's projection with that 181 bushels an acre, with the acres planted that they had, you plug that thing in, you're getting from 2.1, 2.2 this year up to 2.5. Bearish. 17% stocks to use haven't ever been there. So that's the perspective that came out of the Ag Outlook conference. And with that, there's that thing running up higher, about 15%, 17% corn price from 2 years ago, 22, 23, 654, 475 last year, and then a projection of 440. Well, this is where we need alternative opinions, and this is mine. So for the old crop side, what I wonder about is that, yeah, 70% very light. Let's say USDA, they give them their due. They're probably right for this market year, but still, as we finish this thing up, low corn prices, and I think we'll find this out on Thursday. Low corn prices tend to help us have better usage. So looking at increased ethanol, increased exports, and if that comes about as we finish out this marketing year ending up August 31st, if we get this type of strong usage at the end on old crop, then you'd be looking at something over $5 here, at least at 13.4%, is more like a 525, 530. New crop bid, 181 bushels an acre. That's out there. Give about a 1/3 chance that that's right, and it might be, but more along the lines of 176 bushels per acre in the U.S. And see, I've got, instead of this 2.5, I need to change that. It's down to about 2.1, 14.4% stocks to use, closer to 5. It's interesting that although the USDA's projection is 440, the futures showing that 509 that we looked at before. So I think the futures are probably thinking more along a good yield, but not a record yield, and something closer to 5. It's more consistent than that earlier forecast. But again, I know what the earlier forecast was by the USDA. It was setting a baseline. So we started from there, and then people like me come up with all sorts of critiques and whatever, and say, well, we might look at this instead. World corn, world minus China corn supply demand numbers, and we're not just overwhelmed with corn. Still on the edge. Again, we had 11% stocks to use at this 96 million metric tons stocks number last year. If we get a really, really great South American crop in the coming year, and again, that for 23, 24 for so that'd be this crop coming on now. We'll see how that works out. And you can see that this, we've talked about this before, that the amount of corn that's identified as being stockpiled in China, take the Chinese corn numbers out, and you're looking at this purple bar down here, and the world doesn't look quite so overwhelmed, and so you can see kind of the world less China stocks to use numbers, and they're sort of okay. Okay, let's go on. Move quickly to soybeans. So we've seen the structure of things before. Now we're going to move quickly to try to get you out of here on time. So downtrend in May soybeans, highs up just under 14.25, got down to 11.25, drop about $3, had recovered up to about 12.25, gained $1 back. Friday closed at 11.92.5, and we're just hanging out in the volatility until we figure out what's going on. 11.92, and note on that on the corn number, when we got out to November, we were still moving higher on this, on the structure of futures. Here we've come off some, not amazing amounts, but not as optimistic about or as worried about soybean supplies in the U.S. or globally as we were for corn. Cash prices for soybeans, again, the best bid, Hutchinson 1170, best new crop bid, Hutchinson at 1148. And again, bravo for Hutchinson, I guess. They've got they're ending up the best cash and best forward contract bids, and some others pretty representative. Topeka, pretty competitive, and such. You might note, again, if we're trying to think like the USDA projected, and I was at that Outlook conference, and their idea was that, hey, the soybean corn new crop price ratio says soybeans. So that's our story, and we're sticking to it. 2.3 being neutral, and you can see here in Kansas at these locations, new crop corn prices you saw before, and these soybean prices 2.5. And in the eastern 2/3 of the state, clearly, if we go by this, favoring corn, favoring soybeans. Even so, in the Colby area, hardly the center of soybean production, but the ratio is showing up. The only place in the whole state that's not favoring soybeans is where we have to grow corn, in the Garden City area, in feedlots and some ethanol plants. 2.27, it's just below neutral, still favoring corn. You'd seen this before. Just a quick note. Note the managed money specs for soybeans as down to areas again as bearish at 800 million bushels as on a net as they'd been. You see about one time back in 2019 we got there before. Identify the specs on this, and again, same story. Again, just extremely bearish, just jumping off the cliff, and in terms of where prices have gone. We've been there before, but it hasn't stayed around that long. So we'll see. Just note though that if you're wondering about selling into these markets, this is what these folks are thinking right now, and what their positions are. They'll need some proof to do anything else. Note the fall off on the long side also. And, what changes that? Well, you'll have to see what Brazil gets in terms of a crop. We've talked about the seasonality for soybeans, and pretty similar to corn. March and April, May, June, July off some, and then falling off some into August. And note again, futures for the current marketing year, we're coming here out of into March now, and typically we see that run up, and we're pretty flat. Again, I think that's how we stay until we get until there's something else that might be of worry in South America. And we've got the yields 52 bushels an acre projected by the USDA, record high if we get it for 24. Stocks to use numbers, they had that the higher acres, record high production, record high yield, projecting the USDA's projection 4.8 billion bushels. So you've got numbers like this coming out. The market looks at that and says, why worry? I see what the USDA is projecting, and until we get some other signal, we'll go with that, and that's that kind of drives what you saw earlier on these positions. Exports, okay, sort of in the middle, not the best, not the worst. If anything, it's a little bit below average. We look at this each time out, and just more verification that we're shifting the U.S. soybean usage industry in the U.S. towards crush, towards either meal and or particularly biofuels, seeing struggle to keep up export wise. South America is doing well. Brazil in particular, expanded acres, keeping going, and that projection of things being a little bit higher for exports this year with, if we get the great crop they're talking about, but we are planning on domesticating the usage all that much more of soybeans grown in the U.S. Stocks to use, you can see with the USDA's projection, this is where we were last year, 7.6% stocks to use, 9.9, and 400 million carry out. Then with that, their projection drop prices down from 2 years ago, 14.20, 12.65. This current year that we're in, starting September 1 that year, 11.20. So if you actually get those yields on top of those acres and have the usage mix we're talking about, 9.9% stocks to use, lower prices, and you can see where we're at. We'd be as high as we've been since back in 2019-20 marketing year, 2019-20 marketing year. In those years, less some inflation, we were at 857, and we're projecting 1120 now. Bearish though. So this is what they pay folks like me to do. I see what they're doing. Do I believe it? Well, yes, but there's some alternative ways to look at it. First, you got this for soybeans. Again, cheap prices. We end up in increased domestic crush, particularly if there's any with cheap prices, and you've got kind of hidden in here Dan O'Brien's belief that there's more damage in South America that's been reported. We get more exports out of it, some not tremendous amounts, but then so you're going from the USDA's projection 7.6% down to under 5. We've been down to about 1.9 not that long ago. That's a pretty big change. Ends up in you'd have a strong last few months of the marketing year. So 70% chance the USDA is right on. 30% chance that it's not settled yet. Then you come over here on the new crop, and just not going for a record yield, putting in really everything else on the usage side unchanged, just putting in 50 bushels, which is where we've tended to be. You've dropped ending stocks quite a bit from 1120 that they projected. You're at about 1350. So anyway, and in my thinking, there's about a 40% chance we're going to hit a record this year again. We've talked about weather issues, so a greater chance than that we'll have a good yield, but not a great one, and it makes a big difference on the prices. Okay. Oh, should show you this on world stocks to use. Again, we're even with all that's projected for South America coming on like gangbusters, we're still only going from 70 to 77 million metric tons, and if that number, if we shave off the world number because of future cutbacks, 2, 3, 4 million metric tons here, your usage is pretty strong. You're going to take 2 or 3, 4 million metric tons. You're going to end up right down there, and it'll be a tighter situation supported for prices. So we'll see. Okay, boy, we got 1 minute to do wheat. Let me get right after this. Wheat, just like for the other crops, the commodities tend to move together. There's no surprise to those of you watching the markets. They tend to move together. 590 may close on Friday. Down, we had been top 925 way last July. Came down off of that about 775 and have just been in kind of a tortured move downward. Here's Dees that we closed out of. That was 627. March closed out of 613. May now, Friday, 593, lower into harvest. Then we start to climb out 599 and 615 on these contracts, September and Dees. And it basically, we got to get to harvest and move beyond that. And this does show some return to storage. If you're an elevator, you're probably hedging something like that if you're confident on supplies, because that's money in quantity. And note the wheat prices. We're looking at highest bids at the export areas: Salina 580, Topeka 574, Hutchinson 574, other places lower. Best new crop bid 564 Hutchinson, not far behind Topeka, Salina, and somewhat lower elsewhere. I watched this little number down here. Within the last couple weeks, this ratio of new crop hard red winter wheat to corn on terms of forward contracts had dropped to about 1.05. And generally, it's the idea that the rule of thumb I'd been told is about 1.06 is break even to where we start really considering feeding wheat. So we dropped down to that, and then wheat, with having come up a little bit of late, or changes in these commodities, corn also, probably more corn, has taken us out of that. But if we're going to feed wheat, it's down in the Garden City area. That's where cattle are. So just something to watch. The wheat, let's see, I think this is the managed money traders. And note on the wheat side that for hard red, that we're bearish, not as bearish. We have been a fair amount more bearish at different times, but notice the difference in the volume. Again, we sure look at hard red winter wheat, but a lot of folks trading their wheat risk on the Chicago contract. And new crop projections this marketing year in the red. Here's the typical seasonal price, and we come from about February through, well, February into March, moving downward, coming up a little bit. Not a lot that typically happens, although a fair amount of risk. And what's holding this price at 694 was all this strength we had early in the marketing year. The next one coming, come into harvest, and it's in the purple, and just a little bit of carry and then level. So that's how the market's looking at us right now. Hard red winter wheat. Let's see here. Right, in terms of exports, this hits us right in the pocketbook in hard red winter wheat country. The U.S. hard red winter wheat exports dropping from 450 to 225 at the bottom side, trending down sharply lower. That's competition. That's an international competition, largely coming out of the Black Sea region. Russia on the one hand, Ukraine on the other. So, like I say, for we don't wish poor crops to any of these folks, but if there's a shortfall of wheat coming out of there, it probably puts hard red winter wheat back in the competitive market. Here's all U.S. wheat on a weekly basis. Again, that marketing year starts June 1st, and about 41st week through, we're just bouncing along the bottom. And this is a tough story on hard red. Just we're tangibly separated to the lower side. Again, to me, that's this international thing that we're getting out-horsed on the international markets with that cheap wheat coming out of the Black Sea region, and we still sell some, but transportation logistics around the world aren't in our favor, and distance and all hurts. Again, there's the hard red number. I think that was a month ago. Forgot to get rid of that. And food use level, exports having come down, projected will be a little bit of recovery. We'll see how that goes. Some wheat feeding, so not a lot of story there. So to finish up this for wheat, and thank you for your patience, folks. So here's the USDA's projection for this marketing year, 2022-23. It was 883 glory days in hindsight. 720 this marketing year projected down to 6. So so by the time you get a projection like that, that means it's probably ready to turn around. The best cure for low prices is low prices, as they say. So, and here'd be my view. The USDA's projection at that Ag Outlook conference for $6 wheat. Yeah, I see where they got that. I think if drought comes in overseas, we see. Excuse me. Yeah, if we in the U.S. don't get 49.5 bushels per acre overall, and we just get just 46, that we've certainly been there. You cut production down, supplies get tight, stocks to use down to 34%, $8 wheat. That, so there's a lot riding on what happens in the U.S. on the margin of this. If that doesn't happen, we have strong production, and we just kind of bury the market. You get carryovers over 800 million. You're at $5. So we're kind of in a precarious situation in the wheat market, and you can see all that. And so this last thing I'll say, then we're done. But basically, so you have just kind of bemoaned all this that's going on in the international situation, and how we're getting out-horsed export-wise. Yet, when you stand back and look at the world situation for wheat, it's tight. World minus China's stocks to use, 16-year low, 19.7 or 19.6%, down even from last year. You look at the trend for ending stocks from basically 2017-18, boom, 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 just stepping down. And you got that happening at the same time usage is basically up or level. And then you find yourself out here with the lowest stocks to use in the world minus China since basically back in the highly volatile year of 2007-8 marketing year. So my own final thought, and you're free to disagree with me on that in the chat. It seems that the world is myopic. We see available wheat in quantity coming out of the Black Sea region, and oh yeah, we know we're tight over there, but it doesn't matter. We have lots of wheat right now. We'll worry about tomorrow. But so if someday either geopolitical issue comes in, they get a drought over it in that part of the world, and the world says, well, I guess that's not there. And then it comes over here and looks at actually free wheat that could be traded. Part of it could be traded, and they see it in this downtrend, 19.6% stocks to use. It just seems to me out here somewhere we keep putting ourselves closer and closer and closer to an extremely volatile situation in the world wheat market. It's not here now. We're myopically focused on more than adequate supplies. Please buy it. When those supplies don't show up some year, then we're sort of driving away the available stocks. I don't know when that's going to happen, but I would just be watchful, because the fuel is out there. The situation is for a very explosive wheat market, but you couldn't see it by the bids right now in Kansas. Just is as it is.